Well, Gene, that's very interesting on the interest rate front. I want to talk to you a little bit about inflation now that you brought that up. Yes. And certainly we've seen a spike in oil prices and what's going on in the Middle East and the geopolitical risk. How does that play into your design for portfolio adjustments, and how should clients of Citadel Wealth Management think about that? Is that something that we should be concerned about, or how are you handling those things?
Yeah, it's a great question because, historically speaking, when you have a war or a crisis event, usually the markets sell off a little bit at first, but then after the next month or 6 months later or 12 months later, it's almost a non-event. I mean, I know there's a human life aspect, and I do respect, I do worry about the people in the region. It's a tough spot. But if you look from an economic and a financial market perspective, the markets tend to ignore these events after a while. I do think the events now could be a little bit different because we've seen a huge spike in oil. We've seen the aggressive nature of Iran to protect the Strait of Hormuz in terms of shutting it down. And the last point is that there's really no clear time frame when this war could end. The markets don't like transparency. They want to know when things end. And this uncertainty about how long it will last could overhang the market for some time. Taking this together, plus the fact that you have rising oil, rising shipping costs, tariffs still in the background, likely suggests that the Fed really can't cut rates anytime soon, and we should see inflation pick up a bit. Because if you look over the last few years, if you look at inflation, the energy component has been a drag on inflation. This is likely going to be reversing, pushing inflation further and further higher. Take all this together and the fact that you're seeing a strengthening dollar, given the fact that we also started this war when markets were at a higher valuation, expect market volatility to be really picking up dramatically. So what does this mean to a client portfolio? A lot of things we talked about before. Alternatives, be diversified, be disciplined, and look for the long term. But here's some good news. Even if markets pull back, we do believe it's a buy the dip opportunity. Because if you look, right now, as of this recording, the markets are down about 5% from their peak. Historically, a correction where stocks fall 10% or more from top to bottom occurs about once every 13 months. And it's a normal part of investing. We just don't see a bear market anytime. A bear market's when stocks fall top to bottom by 20% or more. To have that, you need a recession, and we don't see a recession anytime soon. Because since 1945, we've only had 3 bear markets without a recession: 1962, 1987, and 2022. So we don't see a recession or a bear market. So we would continue to be a buy the dip buyer, especially given all the money on the sideline looking for better valuations.
It's kind of interesting. About a year ago, we had the announcement of the tariffs, and of course the markets did not like that at all. And to your point, we had a spike down in equity returns, but look how the year finished overall. So that's exactly to your point. These short-term things happen in the market to be ignored for the most part, as long as you keep that long-term focus.
Yeah, and that's a great point. You see these big fluctuations, like the S&P 500 fell 19.8% from peak to trough. Remember, a correction is 10% or more, a bear market is 20%. A correction usually occurs when the market starts to sniff, hey, maybe a recession might be coming. A bear market occurs when the markets say, we are in a recession, or we are definitely going to have a recession. We got pretty close, but then the markets reversed as we saw some buying opportunities, and a little bit of Trump administrations in terms of tariff rhetoric was dialed down a little bit.
So it's normal to have volatility. It's noise. Stay with your plan.
Yes,
absolutely.
Be disciplined.
Be disciplined.
And most importantly, too, also sit down with your Citadel advisor to make sure that your portfolios are not too aggressive or not too conservative relative to your long-term objective. We've had these big market swings back and forth. A lot of times, I suspect some of your, some clients' portfolios may be too overweight stocks, too overweight bonds. Use the opportunity to sit down with your Citadel advisor to say, hey, is my portfolio too aggressive or too conservative? Has anything changed? Let them review the portfolio.